Today we will be talking about Husky energy from the microeconomic perspective. This is ECON 250 MA class from SAIT, team number 3, and team members Harshbir Singh Dillon, MD Isfaki Ahmed, and Lisbeth Morera. In the agenda for today, we will be covering the economic problems, supply and demand, elasticity, cost long and short run, market competition, and we will provide a recommendation at the end. So Husky Energy is a company engaged in hydrocarbon exploration. It was founded in 1938 in Wyoming, the United States, but since 1946 it has its headquarters in Calgary, Alberta. It has operations in Western and Atlantic Canada, in Newfoundland and Labrador with the White Rose Project, also in the United States and in the Asia Pacific region. Husky Energy has two core businesses, which are the integrated corridor and the offshore. So let's move on to the economic problem, and in order to do so, we need to cover the three fundamental questions in economy, which are what to produce, how to produce it, and for whom. So Husky Energy produces oil, natural gas, asphalt, and associated products. Husky has two core businesses, the integrated corridor, which includes the Lloydminster heavy oil value chain, the oil sands, Western Canada production, US refining and Canadian refined products, and the offshore business, which includes production in Atlantic Canada and the Asia Pacific region. So how to produce it? Husky utilizes land, labor, equipment, and capital. The equipment and facilities are designed, constructed, instrumented, and operated to reduce hazard to as low as possible. Procedures are developed, implemented, and continually updated so that safe work practices are followed. Workers are trained, coached, and supervised, and personal protective equipment is always worn. So, for whom? Husky Retail and Commercial Distribution Network runs from Vancouver Island, British Columbia to Miramichi, New Brunswick, and consists of retail outlets, travel centers, car lock operations, and bulk distribution facilities. Let's move on to the short run for Husky Energy, and let's talk about the role of the company. Husky Energy is a corporation, and its common shares are publicly traded on the Toronto Stock Exchange under the symbol HSE. It employs 4,800 people, and the current CEO of the company is Rob Peabody. In October 2020, Cenovus Energy Incorporated agreed to acquire Husky Energy Incorporated in a friendly takeover deal valued at $3.8 billion in shares. So talking about explicit and implicit costs for Husky Energy. Usually the explicit costs of a company involve the costs paid to non-owners. For Husky, we can define as explicit costs the following: material and supplies, higher labor, depreciation on equipment, utilities, rent. Also, for the third quarter of 2020, the capital expenditure were $354 million, including $79 million in Superior Refinery rebuild capital. So, the implicit costs in the company are the cost of using the owner's resources when no payment is made, or a cost that does not require an actual expenditure of cash. For the third quarter of 2020, Husky Energy non-cash impairment totaled $6.7 billion after tax, and were related to lower long-term commodity price assumptions and management decisions to reduce capital investments. So let's see how to cut costs for Husky Energy. During 2020, the oil prices have been historically low, even in negative number, and Husky Energy was not the exception. In the third quarter of 2020, the company reported a net loss of $7 billion. The reported funds from operations for the third quarter amounted to $148 million. So one way to cut costs will be to buy the supplies cheaper or to reduce average costs. The merger between Cenabos Energy and Husky Energy will result in massive layoffs in both companies. The reductions in staff are expected to be approximately 20 to 25% of the combined workforce. This is, of course, bad news for Calgary workforce, but for Husky Energy, it will translate into a stronger company.